Hey everyone, welcome back to Corporate Decoder, the place where we dig deep into the world of business. Today we're cracking open a filing from Franklin Federal Tax-Free Income Fund. It might not sound thrilling, but stick around because the financial world can be just as surprising as finding your lost wallet full of tax-free money. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, a space for more in-depth conversations about all things business. So buckle up, because the choices this fund made in the past year led to a mixed bag of results. Let's see what went right, what went wrong, and what it all means. Scroll April quarter 30, 2025 scroll. This is their annual shareholder report ending in April of 2025. It's like a report card showing how well they managed your money and how much it cost them to do it. But unlike some fund reports, this one actually points out specific choices that impacted performance, both good and bad. Scroll what come to the fund costs for the last year's scroll. Scroll, let's dive into costs. This is a key number because high costs eat into your returns. For Class A shares, which we're focusing on first, the costs on a hypothetical $10,000 investment were $78. That's 0.77% of your investment was $78. That 0.77% of your investment. Scroll reflects do P waivers and or expense reimbursement scroll. This is important that actual costs are a bit lower and you should know that they have to use waivers. Scroll commented the fund performed last year scroll. Time to look at the bottom line. Class A shares returned 220%. Not bad. More than the Bloomberg Municipal Bond Index, which is what they compare themselves to, which only did 1.66%. Scroll overweight funds with no external credit rating. So how did they pull this off? It turns out choosing bonds without a credit rating really helped. Normally we wouldn't want so much unknown debt as that can lead to a lot of risk, but let's see where their choices failed. Scroll duration cull exposure to bonds with 20 or more years to mature to scroll. Being overweight on bonds that mature in 20 years or more actually hurt them. This means if rates change in the next 20 years, they could be stuck with lower interest debt for a long time. The scroll average commonly titelschrift to scroll. Let's look back. Over the last 10 years, Class A shares returned 1.65% each year on average. If you include sales charges as you would in reality, the return drops to 1.26% per year. This fund is massive with total net assets of over $8 billion, like a small country's economy. The management fees weren't cheap, over $38 million. It turns over 9.61%, indicating it has medium activity. This means it shifts around 10% of the portfolio every year. Scroll September 23 to 2024 scroll, one major change. They added 2 new portfolio managers in September, but one of those managers is expected to retire in May of the following year. So it seems like not too much will change going forward. Scroll debt report describes changes to the fund that occurs grew. Now let's hop over to Class A1. For the last year, these shares returned 2.35%, a bit better than Class A. A1 actually has a lower expense ratio at 0.62%. This class is also being an index. Scroll class core looking back 10 years. Class A1 generated 1.75% annually or 1.36% with the sales charge factored in. You hear some crazy returns quoted sometimes. So something under 2% might not sound like amazing performance, but in many of these years, 0% was better than many other returns. So anything in the profit beats other investment choices. Moving on to Class C shares, which returned 1.79%, which is again comparing to the index, but also the worst return so far. Also, Class C has a higher yearly cost of 118%. Finally, onto Class R6 shares, returned 2.55% for the year. R6 has the lowest expense ratio of the bunch at only 0.48% over it, and years, these shares have generated 1.85% on average. And for the advisor class, return to 45% with an expenses of 0.52%. It gives 1.85%. Not really interesting to compare one from another since it's mostly the same. Scroll value golf scroll. One thing stands out. In the investment holdings, they claim to be valued using significant unobservable inputs. It makes you ask these questions. What exactly is so significant that they don't want to tell you? Why such an emphasis if these figures don't matter? Do they not know yet? Scroll economic cavern development. financing Q Screws. The schedule of investments shows a huge variety of municipal bonds. It's their bread and butter, from Alabama to different corners of Washington, with most rated A's in the fund focusing on long and short-term obligations. I believe that this diversity is the safety in low rates and allows small outperformance in the event that something happens or there is a shift in the way money comes in and out of the fund. Now, zooming out from the specifics, Franklin Federal Tax-Free Income Fund seems pretty stable but kind of average. All the classes of shares are all very similar in how well they are doing or not doing. With rates in an unknown place, it becomes uncertain if this will continue or not, because if things reverse, a low income steady bond is a better position than anything else out there. A few things to remember. Make sure to check for high sales charges when picking your class of shares. Overall, I don't think this fund would shoot 20% return numbers, so you need to manage expectations before investing. Alright, that's our breakdown of Franklin Federal Tax-Free Income Fund's latest filing. What's your take on these numbers and what they signal for the fund and its investors, especially in the long term? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, don't forget to check out the Discord in the description. Thanks for watching. See you next time.